We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Patrick Karim from NorthstarBadCharts.com. How are you today, Pat?
Hi, Tom. I'm doing great. It's really fun catching up with you.
It's always great to have you, and we have a bunch of charts to go through here today for everyone. I submitted a question on Twitter to see some of the stuff that people wanted to see. We don't cover individual miners on our show just simply because we want to try and stay a bit more neutral in the space, but we have some interesting ratio charts and a couple other interesting ways to look at the market to try and get some more perspective here. So what do you have lined up first here for us, Pat?
All right, guys. So let's start. I want ratio charts. They often give you a good sense of when let's say in precious metals, when the bull market starts, and everybody, when the metals have broken out, then most people, we look at the miners to see to get that leverage play off the metals, right? Unless you're using options or playing the futures, and you want to see the miners bottom and outperform the metals, and that's usually a healthy sign. And right here, what I have is the silver junior miners versus the silver metal itself. It's on the monthly chart. And here's a 2016. You see how the junior miners, they just outperform the metals, and then downtrend. So here, one test, two tests. Those wicks is noise above that potentially important line. Oh, rejection here. Oh, above, but refused to close the month above it. So you know that this line is super, super, super important. And right here, even in this month right here, I think this is January, gapped up, but refused to close above and close back within the range. Same thing here, another gap up, close back in the range. And now the opposite move is happening. Actually, Tom, we're back at the low of this downtrend. So here, the first, second hit. So you need 3 hits to have a valid trend line. And that right now, if we bounce off this, we're actually confirming the validity of this lower boundary line. And that's where we're at. It's super precarious it looks the maximum fear out there. The juniors, they're getting, they got destroyed. And here is on the monthly close basis. So here you don't see those wicks, even if they give you a lot of information. Mm-hmm. So here you see the cleanness of these touches. So July, I'm really curious to see July, even if it dips below in the next week, below that line, I really want to see it close above this line. And hopefully that morphs into existence to be a valid support line. And then we could give another shot at try to break that upper descending trend line.
Mm-hmm. So Pat, like you and I were talking about before we hit record here, I said you almost seem like a perma bull, a perma silver bull. And in a way, if we look at this chart and we break down below, let's say that lower support line, does that show us that we're in for more of a downside?
Yeah, because after that, you have to, if you break down behind that low, what I see is that if we make a lower low on the monthly chart, so this next dot here, if we break below, and this next dot, we make a lower low below this previous low, then what actually you're starting to morph in existence is a descending channel. So right, you'll have these are lower lows, and here, if you have a lower low, you could imagine there'll be a trend line starting to morph, or maybe a falling wedge, but that's still descending. So until that upper boundary line is broken out, nothing. This could go down for years, months. We have much more weight of evidence showing that we're more in the precious bulls era than against it. But yeah, you're right. If this next line breaks down, then the rapid moves upwards, and those nice lofty targets that I have for the silver junior miners, they're put on hold until this upper boundary is resolved. So this one is going to tell us a lot about the health of the silver juniors.
So Pat, as we see the three confirmation points on the bottom, let's say support line, if we break below that, do we need another three confirmation points to remake that trend?
Well, exactly. So these 3 points, this line will morph into existence on the third close. So let's say July, we bounce off it. So let's say we have a wick and it closes on that line. Then we could say, okay, the price action reacted to that line. So right now, it's not a confirmed support line. I'm kind of guessing that this could be an area where we could have some support, maybe drip on the smaller time frames. But if we closes below, then that trend line is not a trend line. It's just 2 points connected to each other. And then we'll have to see where the monthly close is. And then eventually maybe like 1, 2, 3. So maybe we're starting to morph into a descending channel. So if the price action, depending where it closes in July, we'll have to see. But right now, this is where I'm expecting some support. And if it falls through, then the pattern, instead of being a potentially bullish pattern, we could be going into a descending channel, which is bearish until it closes above this trend line. And this one's valid. So the bullish case, you have to close above this trend line right here.
And as you were saying, the weight of evidence is to the other side of that, to the bullish case, right?
Well, yeah, it is cycle-wise, and the other charts we're going to see, especially the silver chart. That's why I'm expecting some resilience in the silver miners, even if it doesn't look like it right now there. Mm-hmm. But in the next few months, there's some type of bottom here should morph into existence, so we should be able to challenge that upper trend line.
Perfect.
Well, okay, so here it is. So here are the half of that equation of the first one, which is the silver juniors versus silver metal. This is the silver. I'll show you this one first, guys. This is a silver junior miner 6-month candle chart. So these are 6-month closes. So wherever the 6 month closes, so either end of June or end of December, then it's a new point. 1, 2, 3, and we're just approaching this rising trend line. So the way I see it is, as long as we close the year, because the next 6-month close is going to be 31st of December, as long as we close above this inclining trend line, it's all good. You're still in a bullish mode for the silver junior miners. If you close above this line here, you're still in a bullish mode, but you're in like survival mode. The pullback came really deep in. And if we close above this line here, so that means this line that's going down, actually by the end of the year, it won't even be there. It's going to be a line that goes up here somewhere. That's going to be super bullish. That means this previous resistance turned support, these 2016 highs, the market has reacted and said, look, whatever happened during the year, it was just noise. It was whatever market has to digest, but the market refused to close below this line. And you see here, this is like March. So the first 6 months in 2020, it looked like the end of the world here. So on the daily time frames, you had bearish signals. On a weekly time frame, bearish signals. But if you're not leveraged and you waited for that June 31st close of 2020, that was just a wick. Mm-hmm. And it refused to close below that line. So this line is very meaningful. And this neckline right here, I'm really curious to see where we close the year. And depending where we close is going to tell me about the strength going into 2022.
That was for SILJ, right?
That's right.
Perfect.
Look, this is another one. There's the next big trade there on Twitter. He says he noticed that Franco-Nevada often leads gold out of bottoms. So I didn't verify that, but I said, look, I'm going to look at Franco-Nevada, and that chart is so weird or different. Even during 2013, when the metals were correcting, it did great. So some of your expert fundamental guys could probably explain why this chart is behaving this way. But here I'm using some of Michael Oliver, the genius in momentum analysis. Without realizing it, I was kind of doing some of his work. But after interviewing him, it was like, like crazy stuff. So here's the distance from the 12-month moving average. And just see how Franco-Nevada oscillates, and every time it touches this upper trend line or this bottom rail, it gave clear signals that, okay, Franco-Nevada has gone down as most as it can, and some type of a rally will ensue. Well, in February of this year, after the 6 brutal months of going down, it hit that rail, and by magic, that it just, the price action of Franco-Nevada just keeps going up and up. Even if the GDX is correcting, even if gold's stagnating, it keeps going up and up. And that's a good leading sign that if Franco-Nevada could keep going up, that eventually gold can, that it's actually turning a corner. And I have it here on the momentum indicator that it's even above an important pivot line. So if it could close a month above this neckline here, for me, the target is it should get stretched so much away from its 1-year moving average that eventually when it hits that top rail there, we should be hitting some type of targets, like maybe 290 or something like that. But first, we have to close above this neckline. And then you see also how this momentum indicator could break above before the price action breaks out. So here's the previous highs, where usually people are going to wait for a horizontal breakout line around this 220 area, 215 area. Well, the momentum might actually be breaking out before that happens. So this is very bullish for the whole sector, that Franco-Nevada has actually been logging in month after month of going upwards.
Interesting.
And let's go make things crazy like I like to. Then I said, okay, what about the ratio of GDX, the gold miners, versus Franco-Nevada? So Franco-Nevada is some type of special like anchor for the precious metal sector. The Franco-Nevada has been outperforming GDX for a while. So that ratio has been going down and down and down. But the key points is when GDX, the miners have been really doing good, like in 2015 to 16, it outperformed Franco-Nevada. So I'm looking for bottoms in that ratio. So here's a bottom right here. Here's another one down here where the GDX really underperformed the Franco-Nevada, but after that, it put in a nice rally. So I'm looking for support points for where the GDX could say, okay, that's it. Franco-Nevada, I'm going to start outperforming you. And same type of thing like I did with the previous chart, distance from the 12-month moving average. What happens when that bottom rail is hit? And once you break out above an important trend line, see 1, 2, 3, so that trend line morphs into existence. 4, test it again. Once you break out above that, off the bottom rail, then you had GDX really outperform, and that was beautiful for everybody that's in JDXJ. JDX will make good profits. So same type of thing here. See, we're on the way down. So once we hit that rail, that maybe in September or whenever that rail is going to get hit, and as soon as we break out this bullish descending wedge, so this wedge pattern, usually when there's 2 lines going one towards the other, when that resolves upwards, then the target is the top of where that pattern started. So there might be a couple more months of pain or stagnation for that ratio for the JDX doesn't do super great. But as soon as that lower rail hits and it starts moving up and JDX starts outperforming Franco-Nevada, for me, that's another bullish element that we've turned the corner and we're ready for a nice upswing. And here, the final recap for the miners, guys. Monthly chart, my Ichimoku Cloud defined setup with a 1-year and 3-year moving average with volume profiling. So here's the JDX, JDXJ, SILJ, SIL. And this chart, the takeaway is, look, when we had that 2016 run, there were like clear signals that we were maybe even if we were above those 1 and 3-year moving averages, you still had that cloud. So all this overhead resistance that was caused with that 2011-13 top, we were going to run into it. And you see on each of these charts, it kept the price subdued. Here on the SIL, you really see like as soon as it started running to that cloud, those people that bought higher up, they were taking profits, selling those rallies. And now it's completely the opposite that's happening. That's why the bias has to be bullish, because right now we had the same type of bullish cross, a 1 and 3 year. But now there's no more of that cloud. All these sellers of the 2013 top, that's the goal of a big base is to wipe out all these bag holders. And now it's all fresh blood, fresh people that are in. So even if we're correcting and the 1-year moving average is faltering, we have that inclining 3-year moving average that's like the final line in the sand where the worst case, and you don't want it to close below that 3-year moving average for the bull case for all these miners there to hold. So that could drag down maybe for 1, 2, 3 months, like those other racial charts that we saw, where the miners could still like stagnate or consolidate until that 3-year moving average catches up. But you're on the right side of the cloud, guys. You're starting to define green, inclining, Ichimoku cloud defined support.
So is it possible, Pat, that as that goes on, that green cloud builds into, let's say, the size of some of those red clouds that we've seen there?
Yeah, well, I'll show you when we do the gold silver ratio. Here you see that this is the end of the cloud, like because we don't have enough data. This cloud right here, it was starting all the way down here, and eventually it serves as support. And if you go through that and see it's trying to support the price, but if it melts through that, and then you're below 1 year, 3-year moving averages, it's not good. So yeah, that's exactly what's starting to get built. As long as you stay above, you're in an uptrend. Okay, let's go to the ratio charts. Just to see versus US equities, our number one competition. So for capital flows, you want them to go in the miners, or let's say here silver versus the Dow. This is a PNF chart that dates to 1896, guys. Super, a lot of data. And this is how much the Dow has been outperforming the silver and the 2011, 2001 top. And then it started turning over. And look at that. This is the 12 and 36 period moving averages. So they didn't happen often, these signals. So when this had a bullish cross, it was the golden era for US equities versus silver. And this, it never crossed below. Oh, here we had a bearish cross below. That's almost like a big changing of the card. So even if it had some herky-jerky movements, there was something underlying happening saying, okay, so US equities are too much overvalued versus silver. Something's happening. And then you see that beautiful, beautiful descending trend line, multiple touches. And then silver, as we know, it likes to explode. At any moment, it created this like it's 2002 or 3 explosion versus US equities, and then sideways grind. And it's like a magnet, this line. It wants to get retested. It gets tested again. The US equities are not able to outperform silver again. And at any moment, guys, silver just went ballistic, finished its consolidation, and severely outperformed in strong moves versus US equities. All in the meantime, never getting, see, even if it got close, you never had a bullish cross. So as long as that bearish cross is intact, that trend line is intact, these strong moves, these melt ups in silver are possible at any moment. Until, we get back to historical lows in that ratio, where here we think we're God or silver's going to the moon, that calls for $500 silver. Well, this was the 2011 top. Mm-hmm. Then as soon as you got back above and then get that bullish cross here, it was game over for silver. Up until history repeats, Tom, all over again. Same type of setup, multiple trend line touches. This is super valid line. We've had that first drop below these important breakdown lines below that bearish cross, which does not happen often. It's just the second time that this has ever happened in my chart that dates back to the late 1800s. And right now, the only thing we're seeing right now is silver underperforming the Dow, but that magnet is trying to go test that rail just like it did here. So the way I see it, I'm always like, at any moment, silver could start outperforming the Dow. So of course, the logic says that it's not going to outperform until maybe we test that rail one more time properly, or a few times like it did here. But the target is another melt up of silver versus US equities, and to try to hit at least that box here, that 700 to 1 ratio, that median line, which is a logical target, a logical line that wants to get tested. So 700 to 1, you could do the math. So if the Dow is at 30,000, maybe that brings us to, $40 silver or something like that. So that would be probably the next target before silver corrects again severely.
So when did we see that last bullish cross, Pat? That would be mid
2020.
Yeah.
Yeah, pretty much the bullish cross, 2020, when the silver really started. This is the melt up in August, so maybe in a little bit before. The Dow was really struggling versus silver. Silver was creeping up, and that's when we had the bearish cross. Did you ask for the bullish cross?
Yeah,
the bullish cross. Well, the peak was 2011. So
it's bullish for the ratio, but
bearish for silver.
Right. Okay. So is that not bearish? That last cross that we saw in 2020, would that not be bearish for silver then?
It's bearish for the Dow, because this is the Dow divided by silver. So the more silver appreciates, the more this ratio goes down. So right. you want this
bearish for the ratio, which is good for silver.
Yeah.
Gotcha.
Big picture chart, guys. So we're you'll see with the other charts. So we're approaching a turning point, but it's a point and figure chart, guys. So it could range for a little while without adding a new columns of 0 or X's. So there's no time scale on it. It's just a pure price action analysis. Gold versus total public debt ratio, another obscure ratio, but I think some people, they've always seen like, okay, gold, well, how much should gold be valued? The more they have public debt, the more they print, the more there's debt. Gold should try to equate some of those monetary imbalances. So without going too much in those like narratives, let's just look at that ratio, what it showed us. And this in the 1980s era, that ratio was like ballistic. It was so much higher above the graph, above the frame. But I just want to focus on what's happening now. So here, gold undervalued versus public debt. But now public debt, whether it stays flat or goes down or goes up, gold saying, okay, that's enough. I'm going to start appreciating. So the ratio is going up in favor of gold. And then we're starting to create, see, these are Fibonacci spirals, something I was experimenting with. And look, the takeaway, guys, if it's a mathematical type of drawing tool, Fibonacci tool, Fibonacci spiral, Fibonacci circles, it's mathematically reproducible. Then it's not like somebody just drawing some like a tire or an oval and saying, oh, look, that's technical analysis. This is actual math applied to price action, like math that's seen in nature, right? Like Fibonacci, you see it in the seashells, like and humans were like part of like our emotional landscape. So all these elements are related, that once you start seeing these type of spirals or these angles or these arcs, multiple touches, it gives you some type of guidance that, okay, there's some validity. The movement happening here is trying to follow this track line. And look at that ratio, just follow it to perfection. And it's happening here. I have another spiral right here. It's happening again on the way down. 1 touch, 2 touch, 3 touch, 4 touch. And right here, a 4th touch or bouncing. So for me, the confidence of this pathway playing out increases a lot when I see multiple touches of this Fibonacci spiral playing into play. And then when I overlay some here, like a pivot line, multiple touches, I see it as a magnet line. So another touch of the spiral, another touch of this important pivot line, inclining pivot line, and all of that to add something extra. It's encapsulated into an arc. So on the way down, 1 touch, 2 touch, 3 touch. This is the first touch of that right hemisphere. So that right hemisphere is not morphed into existence until I have 2 touches to validate its geometry. So the spiral is effective. It's like, for me, we have to respect it until it fails or reaches its target. But then after that, I have that overlaying arc where this could be another roadmap where we hit that trend line, that pivot line, which is now resistance, and then it forces us to try to morph into existence that right hemisphere of that arc. Yeah, this one's a whew.
And that kind of coincides with as you pointed out there, the 2024, that's kind of the mid-cycle top, right?
Exactly. So we know, like with the November 2024, there's some type of low that we're expecting, and until like the price action drastically changes or overrides that's like kind of a ballpark area where we're aiming. So this is a question of trying to see, okay, where am I going to top? So just a technique to see if this roadmap follows. It could be in July, it could be maybe a little bit before. So somewhere maybe in early 2024, gold can top and then drop severely into its mid-cycle low. It's always roadmaps, just trying to imagine possible plays. And again, guys, like for anybody that's new to chart trading, this is not set in stone by any means. If any of these lines, we have a close below it, then it invalidates that theory. You adapt it, the chart morphs. It's like, Tom, I was trying to think of an analogy like to make sense of this. And it's like you're playing baseball and you're the outfielder and Barry Bonds or somebody hits, I just like denounce my age, right? Who knows Barry? Like the millennials, do they know Barry Bonds, who he is? But in any case, let's say any baseball hitter, Vladimir Guerrero Jr., he hits a ball. Is the outfielder just going to stay there? No, I think the ball's going to go here, or he adapts and he moves his body and catches where the ball's like he sees the trajectory move. He anticipates as new elements come in, and then he catches the ball. So chart trading, same thing. Don't think because he always hits at that area that it's going to land there. Like as the ball moves in the air, like redo the calculations and say, okay, that's where it's going to land. So I hope that analogy helps make some sense.
Yeah, it's just a probability, right?
Yeah, until you finally catch it, it's all probabilities, right? Until he catches that ball, it's up for grabs, At the last second, I know a bird could hit that ball. It could fall right before the guy, who knows what could happen.
But it helps give us some perspective on informing our decisions and adding to your weight of evidence, as you're fond of saying, right?
Exactly. The more you could calculate, the more the baseball, like he practiced so many times, that baseball player, that his brain instinctively is able to calculate all the odds, the chances. But you see with kids, like I see my kid at baseball practice, and how come he didn't go catch the ball? He didn't understand that the ball was going there. Well, they're still learning all this weight of evidence, geometry, angles, ascent, velocity. Look, silver, I did the same exercise, silver versus total public debt. I spotted 2 arcs, 1, 2 touches, 3. So here, up to 2008, it was all good. Silver was outperforming total public debt on its route to its target, which is usually the neckline. But then we had the GFC and that arc failed. So arcs do fail. Then you adapt and then you see what happens. I had other charts where that arc, I stretched it out to encapsulate that. But I said, Patrick, what if you would have been in 2007, like that arc, you would have had to say it failed and it morphed into something else. So this is what probably would have happened if I would have drawn this arc in 2007. I would have said my target's here, but look, some type of event happened and it was like a detour. The forces still brought the price action back up here, but it could have easily not worked out this way. And this could have been a totally different scenario. So just imagine that here I have another arc, 1 touch, 2, 3, 4, 5 touches. Left hemisphere is beautiful. 1 touch, 2 touch. We're right. If we bounce off this right hemisphere on the arc here and we break out above this horizontal trend line, this means silver is going to go ballistic, have a strong move towards that target up here, that stage 2 level versus total public debt. So if total public debt goes up, that means silver is going to go up even higher on this ratio chart. Total public debt, let's say, stays flat, then silver is going to move up, but not as fast. And if total public goes down, silver could also be going down. It'll be going down less fast. But so we got to be careful. I want to see that arc respected, and we're never, again, like 2008 crisis, some type of event could happen and this could break down the arc. And then we revise the target, that upwards target right here. It might not be there anymore. It could be somewhere else. So keep an eye on that, guys.
Yeah, it's interesting different ratios that you have here, Pat.
And yeah, if you see like something outperform different type of instruments via ratio, that's all it is. Then look, I'm outperforming this guy based on technical, and it gives incentive that, Jesus, the instrument you're holding is actually pretty powerful, bullish construct if you're outperforming all these other guys, right? Okay, man, the lumber versus gold, man, this obscure ratio that somebody wanted me to do. And I have no preconceived notions of what this is supposed to mean macro-wise. But this is like since 1973, 1 touch, 2 touch. Okay, on this 3rd touch right here, it just morphed into existence in April when lumber really exploded. And that upper line, each time this line was touched, it was a pretty strong bottom in gold. So I have gold 1973, 1999, 2021, April and Q1, gold is still correcting. So every time this rail was hit, gold had put in good bottoms. So why does that happen? I'm not quite sure. And gold, so from this stage on, gold is just in its preemptive, just warming up type of a bull run. And when it really started outperforming lumber, like here, 1 touch, 2 touch, 3 touch, 4 touch, and then break, gold really, really went up strong. So if I could imagine this same type of line right here at the bottom, I'm expecting that gold come and touch this line. And if it breaks down below this line, then I'm expecting gold to really, really be outperforming lumber at this stage.
And if the trends, let's say, continue for lumber currently, and if we do gain some momentum in gold, then we could easily see that happen, right?
Exactly. Mm-hmm. So yeah, so like you said, like the ratio going down, that means lumber is underperforming gold, but they could both be going up, but gold goes up higher, or they both be going down and gold could be going down just slower. Mm-hmm. Okay, this one's going to be interactive. It's somebody wanted the gold to silver spread or the gold silver ratio. And guys, look on the daily chart. This is my daily setup: 50-day moving average, 200-day moving average, Ichimoku cloud uptrend, beautiful downtrend. But guys, we're breaking out above now. So on the daily time frame, you see here, try to get back up above that cloud. The cloud got it subdued. But now this, by all means, this is a breakout on the smaller time frames. So for those day traders, and we've seen it right in silver sell-off, and gold staying strong, the market's correcting, the VIX spiking up, the US dollar going up. These are all elements that show this chart. Look, even here, it's above an important pivot line on the daily chart: 1 touch, 2 touch, 3 touches, and on the way up, resistance. And now it broke out above. Inclining 50-day moving average and 200-day moving average getting flat. So on the smaller time frames, on the daily chart, the gold silver ratio is actually going up right now, which is not bullish for gold or silver. But you have to see it. Is this a scare, or is this a reset in sentiment where at any moment or at some other moment where we hit resistance, then this turns down, and that's actually fuel for silver to outperform gold a little bit more. And look, this is just a weekly chart. So even if on the daily we're out of that red cloud, remember those first charts I showed you there on those GDX charts? Mm-hmm. This is huge resistance. So, and this is just a weekly chart. So until we start closing below, or until we get out of that cloud, any of these types, the cloud could kick in at any moment, mm-hmm. and bring the price action back down. Until then, after that, eventually, when there's no more cloud, it's easier to get out to get back above.
So the cloud acts as more resistance as well.
Yeah, the red cloud resistance, green cloud support, and then you could use other TA tools to see. Oh, look here, I have a previous highs on the weekly chart, refuse to close back above. So this scenario in my probabilities, I would say, okay, this is less probable scenario of going up here. This one right here to test it, okay, that one's worst case for gold and silver, but this is a probability scenario. And then you could have maybe right here, I just saw another line. So right here, you have some type of, okay, forget these. Here, move that one, move that one. So right here, you have a zone of previous resistance right here, this spot here. So that 73, that 74 to 75 is probably a good area where this might stall. So until we break above those two lines, then you could say, okay, this has to hold up here. Mm-hmm. And if it keeps going up like that, that's super scary, because that means we're heading into some type of March Madness there. Or if the GSR spikes like that, the VIX is going to be through the roof, the US dollar through the roof, and everybody's going to be running for safety. Mm-hmm. So hopefully this is just a reset in sentiment, and this gets sold into, and it's just a reset for gold and silver to drive higher.
So Pat, what else does the moving average cross there at the bottom? It looks like we're just starting to form it right at the bottom. What is that telling us as well? Is that adding to any weight of evidence for the ratio to be moving back up?
Yeah, I think so. So you've seen it previously in the past. So this is the 10-week and 30-week moving average. So you saw on the daily it was super bullish. On the weekly, it's waking up. So that ratio, it's still coming down from a hard hit, but it moved up so much that we're actually having a bullish cross on the 10-week and 30-week. So right now, it's not a time to go short by any means. The GSR.
Mm-hmm.
And yes, that means it has some bullish momentum right here. See, it's breaking out. There's a whole bunch of bullish patterns right here that it's showing until it starts turning down and having red candles. This is a bull mode on the weekly chart. Mm-hmm. I could just zoom out on the monthly. So it's all time frames. They cascade. It's like a small pebble. The daily chart is a smaller pebble. And then if you have many of those pebbles together, then you have the size of a rock. And if you have a lot of rocks, then you have the size of a boulder. Mm-hmm. This is the boulder, the monthly chart. So the monthly chart, you see that's a 1 year and 3 year moving average. They don't cross often. So right now, this is still a lot of overhead resistance you have on top via those moving averages. So that weekly chart really has to do a lot of work week after week after week to start. Now it's already challenging the 1 year moving average. If it closes above that, then it has that overbearing 3 year moving average, which really sets in the tone for those longer, meaningful trends. And so on the longer time frames, super bullish. You have to sell this rally. So as soon as it starts selling, as soon as it starts turning over on the weekly chart, this probably be a good moment to sell that rally in the GSR. But you have to wait. Now, right now, you have to wait for it to turn around there because it definitely has the bullish momentum behind it on the smaller time frames. Mm-hmm. U.S. equities. What's happening with that? This is the 200 or the chart since 1897 for the Dow Jones. The distance from the 3 year moving average, and look how beautiful! Like it's been tested once, twice, 3 times. Broke out above, so you're distancing yourself so much from the 3 year moving average that you're going in melt up mode, and that was the 1929 there melt up, and then the following crash, and then after that it just went back to normal. 1, 2, 3, 4, 5. Steady as she goes. Stock market keeps climbing up or slowly oscillating with not getting too stretched from its 3 year moving average. But then after that, what happened in 1987, it just went crazy up above that super, super meaningful trend line. And that was a sign that we had a market crash in 1987. After that, stayed below that and not getting too stretched from that 3 year moving average. And what did we have here? We started having that melt up in the 90s. And then that final melt up in 2001. And what's curious here is the relative strength or bearish divergence. Even if the markets were doing higher highs, it wasn't able to distance as fast from that 3 year moving average. So that momentum is slowing down, creating, look, I'm going up in price, but I'm not able to go up as fast as I could before. It's like a train losing steam. And as soon as it wasn't able to keep having more traction, the market started rolling over, and then it just went to a bear mode, 2001 crash. And today we have the most resemblance I saw in this type of activity getting stretched away from the 3 year moving average. It's not the 1987 crash. It's not the 1929 crash or melt up crash. It looks a lot like the 2001 top. So we got super stretch above. And even now the price action is going in melt up mode. We're much higher than the 2017 highs. That we're not able to distance ourselves from that 3 year moving average. We're having a lot less momentum. So if this line, we're not able to go above this point here or above the 1 point, this could really roll over and we could start really cascading down into a correction towards that 3 year moving average, which is the 0 line. Mm-hmm. It shows me I want to get a pulse of the U.S. equities, like the underlying strength or weakness, because we know that silver, and this is the Russell, and I have the silver underlined. I just want to show the impacts of a U.S. correction, a U.S. equities market correction, and it comes back to those U.S. versus the Dow versus the gold ratio. Every time, here's the Russell. So here's the Russell's distance from the 17-month moving average. Every time I had a correction towards it, in a bull run, silver after that, whatever monetary imbalances that were required to lift up the Russell. Silver just had a nice rally. You see the Russell corrects. After that, the Russell corrected, then silver exploded. Same thing here in 2010. The Russell exploded off those 2009 lows, corrected. And as soon as the correction was over, silver just outperformed on the way up the Russell. And right here, we've never been so stretched. I've never noticed that before. But here, the last time we were stretched like that was this scenario here when off those 2009 lows. So I'm expecting that if we go back below this neckline right here and the Russell corrects another 10% going into September or October, as soon as the Russell stops correcting and there's no severe market crash, then silver will start outperforming a little bit like we did in August of 2010. There's no market crash, no liquidity crash, but okay, silver now has to price in all that monetary imbalance to keep that Russell up. And then silver really starts outperforming.
Yeah, it's really interesting to look at it compared to the equities here, Pat.
Yeah, they have some type of everything when you put in a ratio, you're creating a relationship, right? Trying to see clues of how they behave in the past. So it's not a one-to-one correlation, but you just want to make sure you're on the correct end of these ratios. You're not where the ratio is completely unfavorable to you historically. You just want to make sure that you're entering where the ratio is set up to where historically it's shown you that it's going to go in your direction, and you'll be able to outperform U.S. equities.
Right.
Okay, some of these charts, guys. This is just some of charts. Okay, it did this in the past. So what did it do after? Well, gold historically, since when the beginning of time, or when this chart starts, when it did a 91% move off a bottom or low, it always did great after. So right here, you had the 1970s. Here you had another one right here. Those 74 lows or 5 lows. It did 91% move off the bottom, 91% move off the bottom, and then it just went ballistic. Those 1999 lows, as soon as it did 91%, that momentum that was required to get it there, well, it just didn't stop there. It went up way more after. And we did another 91% from those 2015 lows all the way to those 2000 on a weekly basis, close to 2020 highs for gold. We did 91%. So I'm expecting the train, it's not over yet. It could be a pause. But if gold history has shown us that once it starts going, that whatever macro driver was required to get it going, to move off 91% off a low, then it's not just done there. It's taking a pause maybe, but it has a lot more pricing in to add on.
So Pat, is there a reason you chose 91%, or like, where did you get that?
I chose exactly. So I chose 91% because I wanted to see, that was the highest, the move we did actually here.
Okay.
And I want to see once that threshold was passed, how much gains we had before. Because here in the 80s, these were like, I think 76% move or 80% move. Well, we did more than that. So I could have, if we would have been at 80% here, let's say we're back before it moves up to all-time highs and we just did 8% move, and I would have done this exercise, I would have had to take into account that, look, Pat, it went up 80% here or 80% here. It's not guaranteed that when it does 80%, it goes up even higher, right? So 91%, it eliminates all. So I want a situation where every single time it did 91%, what did it do after? So I wanted to eliminate these echo bubbles, these that it had going downwards off those that melt up right here.
Right. Interesting.
That's a tough question. I can't believe you asked me that. All right.
That's what we do here, right? Ask tough questions. Or hopefully informative questions.
Yeah, because it's good to challenge my TA, because sometimes I do stuff that I realize at the end, Pat, you were kind of, looking it through what are they called, pink lenses?
Glasses.
Yeah. So it's always good to have like peers or anybody just say, where'd that number come out from, Mm-hmm. And then it makes you think, oh, okay, you're right. Look, that didn't make sense, like what I did. So it's never, hopefully I don't do too many mistakes, but there's definitely probably some stuff there that slips in. Okay. Silver's unique arbitrage opportunity. Here I have silver on top, gold at the bottom. And I decided to draw like a pivot line to discount these melt ups. So here's like the echo bubble. Like as soon as it drew down, I had an important pivot point here. Same thing for gold. And then after that, I saw that I had one touch, tiny touch here, 3. And then that was exactly the same low that was tested off that echo, like the first drawdown after that peak in 2011. And then it got tested on the way up. So that's a meaningful line. Same thing for gold here. And these are all 11-degree angles. So like I was thinking, where's silver? So gold's up here. It's above that median line. It's even drawing a new 11-degree angle line, even higher up. It's above that. It did all-time highs. And silver's still lagging below that median line. It's still trying to work its way out of the bottom, really showing a weakness, relative strength. But that's where it lies, the silver's unique arbitrage opportunity. I've shown the chart previously where silver always does, if gold does a new high, silver always does a new high within, 6 months to 45 months or 43 months, depending if there's a crisis or something. So this here, this target, this rail here, it's begging to get touched. So I don't know when. It depends when this pattern here resolves. It depends on the next chart. I'm going to show you how that resolves. But as soon as this line is resolved, there's going to be a vacuum within 6 months. Gold, when it broke out above its breakout line here, it took, or this line here, it took 6 months to go all-time highs. So silver is really testing that breakout line, unless it's hogging that breakout line for nothing. And it's not going to do a new all-time high, just like it previously did when gold, every single time it did one, silver did one. Then this is the arbitrage opportunity for playing silver in the favor of gold. Okay, the pièce de résistance. This one I did recently. It's a 2-day chart or 2-day close basis of point and figure. A point and figure block is on this one is set at 80 cents. It's based on the ATR, the last 14 period of average true range. So every time you have a 2-day close that's 80 cents higher than the previous box, if it circles, it's going down, then that adds a new circle down. So I don't know what the price is today. I think if we go down another 80 cents on a 2-day close basis, so maybe high 23.80 or something like that, I'd have to draw it. We're going to get a new circle, red circle, that's going to really start challenging that 10 period moving average right there.
Right.
And if we go even a little lower than that, then the arc fails. The way I drew it, it fails. We're below that 10 period moving average. And right here is the distance from that 10 period moving average. And look at that. Every time we closed above that 10 period moving average, we've had a meaningful bull run in silver. And here's, I think, the GFC crisis where we closed 2 circles below it.
Right.
And we dipped right below it. But other than that interruption, look at that, just meaningful. So 2005 all the way to 2011. In 2020, we had exactly the same signal. After staying below that 10 period moving average for all that bear zone, we finally closed above. And the only thing I see here happening is this type of bull flag consolidation above that 10 period moving average, but below this critical breakout line. 1 touch, 2, 3, 4, 5. So look, Tom, we're getting super squeezed, and we saw it in all the other charts that something's going to give. Like either silver breaks down at the stage, and then it's we have to redraw the charts or below the 10 period moving average, and then we have to start looking downwards where it turns back up. And if it starts creating lower lows, then we might be creating a bearish channel, right? Because here's the upper channel line, but I could have drawn maybe here another bearish channel where that will start becoming my target. So like, I don't want to scare guys, but like $8, $4 silver, So I'm looking at the bullish target because I'm close to the breakout line, but the bearish move is be a bearish channel, a little lower, getting these really low targets. But look, this is my lines in the sand, guys. It's not, nobody's calling breakout yet, but we're getting really close to a decision point. And if we do break out, then I can state with some certain high conviction that the $48 target, and as we saw that silver always does a new high after falling gold. So the $48 target is pretty much my lowest target I could have for silver if we close above this descending trend line.
Mm-hmm. Well, hopefully we don't have to redraw any of these arcs and charts, Pat.
Well, yeah. So I'm keeping a really close eye on this one,
mm-hmm.
and the market's going to tell us if it's for now or later or never that we reach that $48 target there. But all that weight of evidence, I hope that I've shown like today that we've been in a strong pullback, but the ratio charts show historically we're low versus a lot of stuff, and we're starting to turn up. So even if we do have a pullback or correction or a stall in the precious metals for whatever reasons, because the U.S. equities want to melt up for another few years, that it's still a low risk, high reward probability for the precious metals, even today.
Yeah,
especially today.
Lower risk entry point.
Exactly. Versus the highest reward. We're not buying Bitcoin at 60,000 right here. You're buying silver at I'm not telling you to buy, but you're at the lower range of the historically where it should be versus these other instruments that we measured against are seen via those ratio charts.
Right. Perfect, Pat. Of course, you guys have all these charts featured on northstarbadcharts.com. How many charts do you guys have on there now?
I think Kevin did a tally there. I stopped counting because he's doing a little bit more charts than me, making me look bad. But I think there's like over 600 charts there in a couple of months. But now we're taking like requests. So to fine tune, I love doing these big picture charts where I keep sharing on Twitter. But some people, they want like minors or they want special charts. And now people have a request mechanism. People could upvote them. So we're able to hit those as time like moves on there and try to give try to handle the most charts that give the most value to the members.
Excellent. Yeah. And of course, you're very active on Twitter. If anybody wants to reach out to you, you're at BadCharts1. And of course, your partner, Kevin Wadsworth, he's North Star Charts now, right?
That's right.
Perfect. And of course, you guys can check out their website at northstarbadcharts.com. Anything else you'd like to hit before we wrap up here, Pat?
Well, I just want to thank you again, Tom. It's always a pleasure. I'm happy when you call me, say, Pat, you want to come on the show? It's like, I don't want to come too often because it makes it maybe look weird, but it's my greatest honor always when you call me there to show up there. And I'm like a soldier. I'll be there. So I'm very happy there. You keep calling me.
Well, I'm very appreciative of all your charts, all your time, all your knowledge that you share with us, Pat. Thanks so much.
Thank you, sir.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.